Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom. Critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes.
Alright, I want to welcome this morning again. It's time to go ahead and start to study. So we'll get started right now. Again, if you're watching this is for people who are studying for the CPA exam. It's a loud study session. It's not quiet. Alright. Let's get started. Compared to accrual basis of accounting, the cash basis of accounting understates net income by the net decrease during the accounting period of accounts receivable, accrued expenses. What does the question say? Compared to accrual basis of accounting, the cash basis of accounting understates net income by the net decrease during the accounting period of accounts receivable, accrued expenses. Let me understand the language because that's more language than anything. That's more language than anything else. Alright, just a moment. Alright. Okay, so let's interpret this one the CPA way. The question says, compared to the accrual basis of accounting, the cash basis of accounting understates net income by net decrease. Net income by net decrease during the accounting period of which one? Accounts receivable or accrued expenses. Okay. All right. So, step 1. Think about accounts receivable. Accounts receivable decreases. What does that mean? Beginning accounts receivable, example $100, ending accounts receivable $70, decrease by $30. This means the company collected $30 more. $30 more cash than revenue earned during the current year. Accrual basis, revenue recognized, revenue earned. Cash basis, revenue recognized, cash collected. Okay, so accrual basis, revenue recognized equals revenue earned, even though you have not collected the money yet. Cash basis, revenue recognized equals cash collected. Since cash collections are greater than revenue earned, cash basis income is higher, not lower. So a decrease in accounts receivable causes cash basis income to be overstated, not understated. Answer for accounts receivable is no. Think about accrued expenses. Accrued expenses decrease. Example, beginning accrued salaries payable is $100. Ending accrued salaries payable is $60. Decreased by $40. This means the company paid off old liabilities. Accrual basis, expense recognized equals current year's expense. Cash basis, expense recognized equal cash paid. Cash paid includes current year's expenses plus old accrual expenses. Therefore, cash basis expenses are higher. Higher expenses, lower net income. So cash basis understates net income. Answer for accrued expenses, yes. Okay. I'm trying to follow this. Maybe the explanation is too much. Let me try to understand. Compared to the accrual basis of accounting, the cash basis of accounting understates the income by the net decrease. The income by the net decrease during the accounting period of. I still don't understand the language compared to accrual basis. Let's interpret it phrase by phrase. Phrase 1. Compared to accrual basis of accounting. Translation. Pretend we have two income statements. One is prepared using accrual accounting, the other one cash accounting. Okay? The question wants us to compare them. Phrase 2. The cash basis of accounting. Translation. Now focus on the cash basis income statement. Cash basis only cares about cash received, cash paid, nothing else. Phrase 3. Understates net income. This is the key phrase. Translation. Which item makes cash basis net income lower than accrual basis net income? Okay. Which item makes cash basis net income lower than accrual basis net income? Think accrual net income is $100. Cash net income is $80. Cash basis is lower. Therefore, cash basis understates income. The question is asking which decreases would make cash basis income too low. Phrase 4. By the net decrease during the accounting period of. Translation. Suppose these accounts went down during the year, not increased. not stayed the same, they decreased. The question asks, if these accounts decrease, does that make cash basis income lower than accrual income? First column, accounts receivable. Immediately think, what is accounts receivable? Revenue earned, but cash not yet collected. Example, you perform a service for $1,000. Accounts receivable is $1,000. Okay. Revenue is $1,000. No cash yet. What happens when accounts receivable decreases? It means customers are paying old balances. Cash comes in. Example, beginning accounts receivable is $100. Ending accounts receivable is $60. Decreased by $40. That means customers paid $40. You collected $40 of old receivables. Okay? Effect on cash basis income. Cash basis records the collection as income. More cash collected, more income. Therefore, cash basis income goes up. The question asks, does this make cash basis income lower? No. Second column, accrued expenses. Translation, expenses incurred but not yet paid. Example, salaries payable, interest payable, utilities payable. What happens when accrued expenses decrease? Example, beginning accrued salary, $100. Ending accrued salaries, $60, decreased by $40. You had accrued salary to pay, but you paid $40 salary, you still have $60 to pay. That means the company paid $40 of old obligations, cash went out. Effect on cash basis income. Cash basis records expenses when paid. More cash paid, more expense. More expense, lower income. Therefore, cash basis income goes down. The question asks, does this make cash basis income lower? Yes. The question is really asking, when these accounts decrease, which one causes cash basis net income to be lower than accrual basis net income? Makes sense. Let me read it again. Compared to the accrual basis accounting, the cash basis accounting understates net income by the net decrease during the accounting period of accounts receivable, yes or no? Accrued expenses, yes or no? Accounts receivable. Compared to the accrual basis of accounting, the cash basis of accounting understates net income. Let's forget about the first part. The cash basis of accounting understates net income by the net decrease during the accounting period of. Understates net income. In accounts receivable, it does not understate net income. Accounts receivable understates net income by the net decrease. Okay. So the net decrease means if accounts receivable decreases, what effect that will have on net income? If accrued expenses decreases, what effect it will have on net income. That's what I'm thinking, yes. It's more language than anything. So here's what I'm thinking here to make it clear. Compared to the accrual basis of accounting, the cash basis of accounting understates net income by the net decrease during the accounting period of accounts receivable accrued expense. That means if accounts receivable decrease, what effect that will have on net income? Will net income go higher or will net income will go lower? Right? If the cash basis of accounting understates net income by the net decrease, if accrued expenses decrease, what effect that will have on net income? Yes, that's exactly right. The right way to read this question. The question is not really testing accounts receivable or accrued expenses. It is asking if this account decreases, does cash basis net income become higher or become lower compared to accrual basis net income? Let's apply your thinking. Accounts receivable decreases. Ask yourself, if accounts receivable decreases, that means customers are paying, your net income is increasing. Accounts receivable decreases, net income increases. So net income goes higher. Okay? So accounts receivable decreases. Ask yourself, why would accounts receivable decrease? Because customers paid cash. Cash comes in, cash basis loves cash. So cash basis revenue increases. More revenue, higher net income. Therefore, accounts receivable goes down, cash basis net income goes up. All right, the question asks, does cash basis understate net income? No, it does not. Because when cash is coming in, net income is going up. When accounts receivable is going down, that means old customers who owed you money, they are paying that money, so more cash is coming in. So net income is going up. Accrued expenses. If your accrued expenses are going down, your net income is also going down. The reason is because accrued expenses are expenses that you have accrued, but you have not paid yet. Now that you have started to pay your expenses, you're taking that money from your income, so your income is going down. So in this case, net income will be understated. That's what the question is asking. Wow. So it's no, yes. Accounts receivable, will you understate account receivable? Will you understate net income if accounts receivable is decreasing? No. Net income will be going up. Okay? Will you understate net income if your accrued expenses are decreasing or going down? Yes, because you're taking money from net income to pay your expenses, so net income will be going down. That's the question. Let me read it again. Compared to the accrual basis of accounting, the cash basis of accounting understates net income by the net decrease during the accounting period of accounts receivable. Is that a yes or is that a no? Accrued expenses. Is that a yes? Is that a no? So what we said is accounts receivable. When accounts receivable is decreasing by the net decrease of accounts receivable, income goes up. Accounts receivable goes down, income goes up. Accrued expenses, when that goes down, net income goes down because you have to take money from net income to pay your expenses. Okay. I think we got it. Cash basis accounting recognizes revenues and expenses when cash is received or paid. A decrease in accounts receivable is reported as revenue under cash basis, thus overstating net income. A decrease in an accrued expense, that means a payable, is reported as an expense under cash basis, resulting in overstated expenses, which understates net income as compared with accrual basis. Okay. Bizco had $150,000 in cash basis pre-tax income for the year. Pre-tax income, $150,000. At the current year end, accounts receivable decreased by $20,000 and accounts payable increased by $16,000 from their previous year and previous year-end balances. Compared to the accrual basis method of accounting, the company's cash basis pre-tax income is higher or lower? Understand the question again. What's the name of the company? Let's say Kinko. Kinko has $100,000 in cash basis pre-tax income for the year. At the current year end, accounts receivable decreased by $20,000. Accounts receivable decreased by $20,000. So that means we have $20,000 that comes in. And accounts payable, money they had to pay, increased by $16,000 from their previous year-end balances. Compared to accrued basis method of accounting, Kinko's cash basis pre-tax income is okay. Is it higher by $4,000, lower by $4,000, higher by $36,000, lower by $36,000? Which one is correct? So let's think about it. Let me do that. I have a way to think about it, but let me do it for the sake of the video, so we don't spend too much time on it. It's language. This part of the exam is language. Understand language. All right. So Kinko had $150,000 in cash basis pre-tax income for the year. Translation: start with cash basis income. Cash basis income is $150,000. This is our starting point. Phrase 2. At the current year end, accounts receivable decreased At the current year end, accounts receivable decreased by $20,000. Stop here. Ask, what happens when accounts receivable decrease? Accounts receivable decrease means customers paid cash. Yes. Cash came in. Cash basis loves cash. Therefore, cash basis income increases by $20,000. So cash basis is $20,000 higher than accrued because of this. Right, plus 20,000. Phase 3, and accounts payable increased by $16,000. Stop here. Ask, what happens when accounts payable increases? Accounts payable increase or not decrease. Accounts payable increased by $16,000. When accounts payable increased, that means expenses were incurred but not paid. Cash stayed in the business. Cash basis did not record the expense. Therefore, cash basis income is higher. Why? Because accrual recorded the expense, but cash basis did not. Right, plus $16,000 for cash basis. Okay. Phase 4, from their previous year-end balances, translation, these are changes during the year. Nothing else to do. Phrase 5, compared to the accrual basis method of accounting, King's cash basis pre-tax income is higher because money came in and money that was supposed to go out did not go out. So cash basis increased. Effects of accounts receivable. Now compare. Effects of accounts receivable decrease. Cash basis higher by $20,000. Effects of accounts payable increase. Cash basis higher by $16,000. So total difference, $20,000 plus $16,000 is $36,000. The far thinking, you don't even need formulas. Just ask, accounts receivable decreased? Did cash come in? Yes. Cash basis income goes up. Accounts payable increased. Did cash stay in the business? Yes. Cash basis income goes up. Both increase cash basis income. Total increase is $36,000. Okay, this is very important to understand. So higher by $36,000. Higher by $36,000. Okay, just a second. Okay, next question. A company has the following accrual basis balances at the end of its first year of operation. Unearned income, unearned consultant fees, $2,000. Consultant fees receivable, $3,500. Consultant fee revenue, $25,000. $25,000. The company's cash basis consultant revenue is what amount? Okay, check this out. A company has the following accrual basis balances at the end of its first year of operation. Unearned consultant fees, $2,000. So that money they have not earned, they provided the service? No. Unearned consultant fees. They may have received the money, but they have not provided the service yet. Unearned, so for cash basis, they have not earned that money. They receive it, it's a liability for them because they need to provide the service. Unearned consultant fees, $2,000. Consultant fees receivable, $3,500. So consultant fees receivable, they provided the service, but they have not received that money, the $3,500. Consultant fee revenue, $25,000. They have a revenue of $25,000. The company's cash basis consultant revenue is what amount? Unearned consultant fee. Unearned consultant fee is $2,000. If it's unearned, you receive the money. Alright, let me do that instead. I could take some time to think it through, but let me do that. Okay, let's do this. A company has the following accrual basis balances at the end of its first year of operation. First year of operation. Translation: everything they are giving you is under accrual accounting. Okay? Our job: convert accrual revenue into cash basis revenue. I see. Phrase 2. Unearned consultant fees, $2,000. What is unearned revenue? The company received cash but has not earned it. The money came in but they have not provided the service. Journal entry: cash, $2,000. Unearned revenue, $2,000. Notice cash was received. Revenue was not recognized. Effect on cash basis. Cash basis counts cash received as revenue. Therefore, this $2,000 is included in cash basis revenue. Think, cash came in, but accrual didn't count it as revenue. So we must add $2,000. Phrase 3. Consultant fees receivable, $3,500. What is a receivable? Revenue was earned, but cash has not been collected. Journal entry: accounts receivable, $3,500. Revenue, $3,500. Notice accrual account is as revenue. Cash basis does not. Counts it as revenue, okay? Accrual counts it as revenue. Cash does not count it as revenue. Effects on cash basis: no cash has been received. Therefore, cash basis revenue does not include it. Think accrual counted, cash basis did not. So we must subtract $3,500. Phrase: consultant fee revenue, $25,000. Phrase 4. This is accrual basis revenue. Start here, $25,000. Put it together. Start with accrual revenue, $25,000. add unearned revenue, which is $2,000, subtract receivable, $3,500. So that's $23,500. To convert accrued revenue to cash revenue, add liabilities related to revenue, unearned revenue, add. Subtract assets related to revenue, accounts receivable, subtract. So $25,000 plus $2,000 minus $3,500. Okay. That makes sense. Okay. For revenue, accounts receivable equals earned but not collected, subtract. Unearned revenue equals collected but not earned, add. That's the entire logic behind this question. Okay. Accounts receivable. Accounts receivable, earned but not collected, subtract. Unearned revenue, collected but not earned, add. That's for cash. Okay? So that's what it is. So it's $23,500. $23,500. So what is the logic behind it? A company has the following accrual basis balances at the end of its first year of operation. Unearned consultant fees. This is money that came in but they have not provided the service. For cash, we count that as money. We count it as revenue for cash. For accrual, it's not counted as revenue. All right. Consultant fees receivable. Consultant fees receivable. This is a service that you have provided, but you have not collected the money yet. It is receivable. That's $3,500. That $3,500 accrual, we'll say, okay, well, you provided the service, so we're gonna add that money, but you have not collected the cash. For cash basis, this is not money yet. You need to subtract. So that's why we add $2,000 and subtract $3,500. That's why we have $23,500, because we started with $25,000. So what do you need to understand? Cash basis recognizes revenue when cash received. Expense when cash paid. Accrual basis recognizes revenue when earned. That means when do you earn it? When you provide the service. So that means even though you receive the money, you have not provided the service, it's not earned. And even though you provide the service, but you have not received the money, it is earned. But you have not received the money, it's earned. So accrual basis is going to record that as income. Expense when incurred. When incurred. So even if you pay the money now, you have already paid the money. But if the service has not been provided to you, accrual basis considers that as an asset. Okay? So that's what we need to understand. All right. Under accrual basis, revenue is recorded when it is earned. Revenue recognition, performance, obligations met, regardless of cash payment timing. Under cash basis, revenues are earned when cash is received from the customer, regardless of the state of performance. Regardless if you have provided the service or not, If you receive the cash under cash basis, it is money. But under accrual, regardless of when you receive the cash, if the service is provided, it is money. So they count it as money. Alright, so I think we understand that. I understand it. Saver Co. had $100,000 in cash basis pre-tax income for year 9. At December 31st, year 9, accounts receivable had increased by $10,000 and accounts payable had decreased by $6,000 from their December 31st, year 8 balances. Compared to the accrual basis method of accounting, Saver's cash pre-tax income is what? Higher by $4,000, lower by $4,000, higher by $16,000, lower by $16,000. Let's go back to the question. Saver Co. had $100,000 in cash basis pre-tax income for year 9. So we start with $100,000. At December 31st, year 9, accounts receivable had increased by $10,000. When accounts receivable increase is because you provided the service, but you have not received the cash. Accounts receivable increased, and this is something that needs to be subtracted under cash basis. You need to subtract that $10,000. Okay? And accounts payable had decreased by $6,000. Accounts payable, that money that you owed other people, that you started to pay them, and you paid them $6,000. So this is something that you need to subtract also. So you subtract $10,000, you subtract $6,000, so it goes down by $16,000. Yes. Lower by $16,000. All right. So accounts receivable has increased. When accounts receivable goes up, net income goes down, so subtract. Accounts payable decreased. When accounts payable decreased, you need to subtract because it's money that's coming out of your pocket. Accounts payable is money you owe somebody else. You have not paid them, but once you start paying them, accounts payable is going down because let's say you owe $10,000, you paid $6,000, your accounts payable goes down by $6,000. Where did that money come from? That money came from your income. So your income is going down. You need to subtract that $6,000 from your income. So that $100,000 you had at the beginning is not $100,000 anymore because you had to take $6,000 to pay the light bill. You took $6,000 to pay the light bill, so it's not $100,000 anymore. So subtract that $6,000 from it. And you also had accounts receivable had increased by $10,000. So you have people who owe you money, they have not paid you yet, $10,000. So that money, you have not received that cash. Under cash basis, you need to subtract that $10,000 because I had not received that money. So that's why it lower by $16,000. And this is correct. Okay, we start where we're understanding it. Okay, lower by 16,000. Let's do it. All right. Check to see our timing. Presco had $100,000 in accrual basis pre-tax income for the year. Okay, $100,000 accrual basis pre-tax for the year. So that means we start with $100,000, but remember that money is not cash, it's accrual. So we may need to make some adjustments. Okay, at the year end, accounts receivable had increased by $10,000. Same thing. Accounts receivable increased. That services you provided that people did not pay you, but in accrual basis, it is recorded under the $100,000. It's recorded. It is in there. So $10,000 of services that you provided, they have not received that money. Okay, so this is accounts receivable had increased by $10,000, and accounts payable had decreased by $6,000 from their prior year. That's the same question. All right, so accounts payable had decreased by $6,000. Accounts payable decreased, that means money you owed other people, you start to pay them. From that $100,000 that originally we had, there is $10,000 that we have not received yet. We provided the service, but these people are not paying yet. We got to send them to credit. All right, there's $10,000 that we have not received yet. That is recorded in that $100,000. We have to subtract. We need to subtract that $10,000, so that makes it $90,000. Okay, accounts payable had decreased, and we are not receiving our money, but we are paying other people their money, right? So $6,000 we start to pay people. Where did we take that money from? From the $100,000. We took it from the original $100,000. So that means $16,000 has been removed from that money, from the $100,000. How much is left? What is the question? Under the cash basis of accounting, what amount of pre-tax income should Price report for the year? All right, so 100,000 minus 16,000. Let's do it. We should know what it is. 84? Could be 84. Yeah. 100,000 minus 16,000. Okay, 84,000. That's what it is. And this is correct. It's almost the same question. Once we understand that, we got it. Can get every single question. Once we understand it, we understand it. That's it. Once we got it, we got it. Okay. So let's go. Whiteco wants to convert its year one financial statements from the accrual basis of accounting to the cash basis. Both prepaid supplies and office salaries payable increased between January 1st, year 1 and December 31st, year 1. To obtain year 1 cash basis net income, indicate whether these increases should be added to or deducted from accrual basis net income. We need to understand. Prepaid supplies, office salaries payable. So what is the question? To obtain year 1 cash basis net income, indicate whether these increases should be added to or deducted from accrual basis net income. So prepaid supplies. If you prepaid money, right? You prepaid. Let's say you prepaid your light bill for the whole year. It's $6,000, for example. You prepaid. this is money that came out of your net income. For cash, for accrual basis, it is not yet an expense. The reason it's because it considers it as an asset, because that's money you paid, but you have not received the service yet. Under cash basis, this is an expense because the money came out of your account. It is an expense for cash basis. So prepaid service needs to be deducted. You need to deduct prepaid service, office, salaries payable. So you have the office. Let's say you have used the office space for 3 months, but you have not paid the 3 months of use of the office. For accrual, this is an expense because you have already used the service. For cash, since you have not paid the cash, that means this cash remains in your account. We need to add it back. We need to add that back. So, prepaid services you need to deduct. Office supplies you need to add. Yes. Office salaries. Office salary. Okay, salaries, not office use, but office salary payable. That means you need to pay salaries. People worked this month, you pay every month. I haven't seen the job that paid every month anymore. But you pay every month. And they work the whole month, they have not get their money. They have not gotten their money. You still have that money in your bank account. It is added to your income. It's still part of your income. Under cash basis. Until you pay that money, it's still income to you under cash basis. So, the question says, to obtain the year 1 cash basis net income, indicate whether these increases should be added to or deducted from accrual basis net income. Should you prepaid supplies that you prepaid, should you deduct that money from from accrual to have net, to have cash? Yes, you need to deduct that, because that money that came out of your pocket, money that came out of your bank account, you need to deduct it. Office salaries payable, that money you need to pay your employees, you have not paid them yet. This is something you need to add because it is still in your pocket. That money remains in your bank account. You have not paid that money yet. So you cannot deduct that money from under cash basis. You cannot deduct that money because you have not paid that money yet. It is still in your account. So you add. Deduct prepaid supplies. Add office salaries payable. Add payable, deduct prepaid. All right, that makes sense. I'm explaining this and that makes sense. That's correct. In its cash flow statement for the current year, Nesco reported cash paid for interest of $70,000. All right, in its cash flow statement for the current year cash flow statement, Nesco reported cash paid for interest of $70,000. Nest did not capitalize any interest during the current year. Changes occurred in several balance sheet accounts as follows. Accrued interest payable, $17,000 decrease. They say payable, they say decrease. So it was payable, it's not payable anymore. Because if it decreases, that means you have paid that money. Prepaid interest, $23,000 decrease. Prepaid interest. Ooh, it's a little bit difficult for me now to understand. In its income statement for the current year, what amount should Nest report as interest expense? Okay, let's see. Asset payable, asset interest payable, $17,000, but it's a decrease. If payable increased, you would add. But if payable decrease, you will subtract. Subtract $17,000. Payable decrease, you subtract because that's money you took out of your account to pay. That will decrease your bank account too. Okay? $17,000 decrease. Prepaid interest decrease. Prepaid. If prepaid decrease, prepaid decrease. No matter how it is, if it's prepaid, that money you took out of your account that you paid, that money that was taken out of the account that you prepaid, money has come out of your account. So, all right, let me do that so I don't confuse anyone. Let me do that. Alright, so phrase 1, cash paid for interest of $70,000. Interest $70,000. Translation, this is cash basis interest expense. Start with $70,000, cash paid. Phase 2, accrue interest payable decreased by $17,000. Stop, ask yourself, what does a decrease in interest payable mean? It means you paid off some old interest from a prior year. That's right, that money that came out of your pocket. Accrued payable, interest payable decrease. You paid that money. Okay? It means you paid off some old interest from a prior year. Example, beginning payable $25,000. Ending payable $8,000, decrease $17,000. So you paid $17,000. Okay, you paid $17,000 that belongs to another period. Therefore, the $70,000 cash payment includes current year's interest plus $17,000 of old interest. So accrued expense must be less than cash paid. Subtract $17,000. That's it. Running total, $70,000 minus $17,000 is $53,000. Phrase 3, prepaid interest decreased by $23,000. Stop. Ask yourself, what does a decrease in prepaid asset mean? A decrease in prepaid asset, that means you're using the service. It means some previously prepaid interest was used up this year. That's right. Example, last year you prepaid interest. This year, that prepaid amount became expense. No cash paid this year, but accrual accounting must recognize the expense. Therefore, add 23,000. Running total 53,000 plus 23,000 is 76,000. What happened? Okay, the prepaid service interest you have already prepaid last year that you recorded on last year's statement, so you cannot record that money again. So you need to subtract that. You need to add this back. You need to add it back. That makes sense. So what actually happened? Cash paid $70,000 included $17,000 from a prior year's liability. So remove it. Current year cash interest $53,000. Then $23,000 of old prepaid interest expired and became expense this year. Added. Interest expense $76,000. Do we understand? One line memory rule. Okay, let me see. To convert cash paid to accrue expense, expense equals cash paid plus ending payables minus beginning payables plus beginning prepaid minus ending prepaid. Or more simply, payable goes down, subtract. Payable goes up, add. Prepaid goes down, add. Prepaid goes up, subtract. Okay? Payable goes down. Payable is money that you need to pay, and you pay them. It goes down, you subtract. Payable goes up. That's money you have to pay that you have not paid yet, that remains in your account. You add. Prepaid goes down. That's money you paid. Prepaid goes down, you add. Prepaid goes up, you subtract. I need to understand prepaid. I need to understand the prepaid part. Prepaid goes down, you add. Prepaid goes up. Is it services that you prepaid? If you prepaid a service, you prepaid $6,000 for light bill. Would you add that, or would you subtract that? A prepaid interest is simply cash paid now for something that will be used later. Example, prepaid rent, prepaid insurance, prepaid interest, prepaid utilities, if paid in advance. Example, you prepay $6,000 of electricity. Suppose on December 1st, you pay $6,000 covering the next 6 months. Journal entry, prepaid utilities $6,000, cash $6,000. At this moment, cash went down. Expense did not happen yet. Why? Because you have not used the electricity yet. Later, suppose 1 month passes and $1,000 has been used. Utilities expense $1,000. Prepaid utilities $1,000. Now, expense goes up. Prepaid goes down. Notice the relationship. When prepaid decreases, expense is being recognized. That's the key. Okay. So we're not talking about income, we're talking about expense, which is different. That's the key. Far shortcut. Think prepaid equals future expense stored on the balance sheet. When prepaid goes down, the future expense has become a current expense. Therefore, prepaid goes down, expense goes up. So add it to expense, not to income. You add it to expense. Why did we add $23,000? The question said prepaid interest decreased by $23,000. Translation: $23,000 of previously prepaid interest became this year's interest expense. No cash was paid this year for that $23,000. The cash was paid last year, but it is still this year's expense. Therefore, add $23,000 to get accrual expense. Memory trick. Is the prepaid account getting bigger or smaller? Prepaid increases. You paid cash but have not used it yet. Expense it too low. Subtract. Prepaid decreases. You are using up what was prepaid. Expense is increasing. Add. Alright, so I think I was confusing expense and income. So it is inverse. Exactly. That's the breakthrough. You were mixing up the rules for revenue, income, and expense. They are often mirror images of each other. Think of it this way. Account, you have receivable. The revenue increase. Expense question. Okay, let me see. Alright, so yes, the easiest way to remember it is revenue. Ask, did I earn revenue without receiving cash? That's account receivable. Did I receive cash without earning revenue? That's unearned revenue. Expense. Did I incur expense without paying cash? That's payable. Did I pay cash without incurring expense? That's prepaid. For the prepaid interest question, when prepaid decreases by $23,000, that means I already paid the cash in a prior period. But now I am finally recognizing the expense. So expense goes up. Therefore, you add it. Okay, makes sense. Makes sense so far. So, did we understand that? Let's go back to the question. In its cash flow statement for the current year, Nesco reported cash paid for interest of $70,000. Nest did not capitalize any interest during the current year. Changes occurred in several balance sheet accounts as follows. Accrued interest payable is $17,000. Accrued interest payable, $17,000. Prepaid interest, $23,000. Decrease. Okay, so accrued interest payable, $17,000. Decrease. Your payable decrease. That money that came out of your account, you need to subtract. Reported cash paid for interest. Payable decrease. You need to subtract. Prepaid decrease. You need to add. We're talking about expense. But now we're not talking about cash, we're talking about accrual. Okay? We're talking about accrual. Okay. Yeah, this we need to understand it. Because there are several ideas that are being mixed up. In its cash flow statement for the current year, Nesco reported cash paid for interest of $70,000. Nest did not capitalize any interest during the current year. Changes occurred in several balance sheet accounts as follows. We have the changes in its income statement for the current year. What amount should Nest report as interest expense? So in this question, we are changing from cash to accrual because Nesco reported cash paid for interest of $70,000. This is cash. So we need to convert that into accrual. The cash. Oh wow, it's already time for break. Okay, so when we come back, we'll continue with this question.
Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom. Critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. With a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. With a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. May He give you wisdom. Critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain study with me. Come study with me. Come study with me. Come study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Study with me. Come and study with me. Come and study with me. Come and study with me. You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp, with a great memory. With a great memory. May you pass every exams. Come study with me. Come study with me. Come and study with me. Come study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes.
All right, we are back.
You've got what it takes.
Back to work.
May your brain be so
Ooh, that was too loud. All right, so we were back to work. Okay, so let's go back to the question we were working on. That question was is a little bit confusing. In its cash flow statement for the current year, Nesco reported cash paid for interest of $70,000. Nest did not capitalize any interest during the current year. Changes occurred in several balance sheet accounts as follows. Accrued interest payable, $17,000 decrease. Prepaid interest, $23,000 decrease. In its income statement for the report what amount should Nest report as interest expense? Okay. So the first thing we need to understand here, we're talking about converting from cash to accrual. Converting from cash to accrual. We're not talking about income, but we're talking about expense, which will make a difference. Okay. All right. So in this question, there are some concepts that are being mixed up in my mind. So to start, in this question, we start with cash and we need to convert into accrual. We're not talking about income, we're talking about expense. I believe having that in mind will really make a difference. So now, explain the question to me again, based on this idea. All right. Yep, so that's taking too long. All right, yeah, so that's taking a long time. Nope, this ain't working. Okay, let me go back. Let's do it again. Do it over. This question has some concepts that seem to be mixed up in my mind. here we are talking about cash converted into accrual. And we are talking about expense, not income. Based on that, explain the question to me again. Yes, this is exactly where people get mixed up. Because most of the time we practice cash income to accrue income. But here we are doing cash interest paid to accrue interest paid, to accrue interest expense. Let's slow it down. Yeah. What are we starting with? All right, let me read the question. In its cash flow statement for the current year, NASCO reported cash paid for interest of $70,000. Okay, cash paid. This is expense. NAS does not capitalize any interest during the current year. Changes occurred in several balance sheet accounts as follows. Accrued interest payable is $17,000 decrease. Prepaid interest $23,000 decrease. The question is, in its income statement for the current year, what amount should NAS report as interest expense? Okay, that's where we are. Step 1. What are we starting with? The question gives cash paid for interest is $70,000. So this is money paid for interest. This is what we are starting with. And remember, it's cash. So we understand the difference between cash and accrual. This is the cash basis number, okay? So think cash interest expense equals $70,000. Now we need to convert it to accrual interest expense. Yes. Step 1, understand the accounts. Accrual interest payable goes down by $17,000. This means the liability got smaller. Liability got smaller. Think, beginning payable was $20,000. Ending payable is $3,000. The company paid off old interest that had been expensed in a prior year. So during this year, cash paid $70,000. During this year, cash paid $70,000. Because now we're talking about cash. The money is coming out, so they are recording it under the cash basis. The money is coming out, but some of that money, that's my own thoughts, some of that money had been expensed already under the accrual basis because it had been accrued last year. So it had already been recorded. So cash paid $70,000. Part of that payment was for last year's expense. Therefore, cash paid is greater than this year's expense. Yes, this year's expense may be only $50,000. But cash you're paying this year is $70,000. Why? Because there is $20,000 that you incurred last year that you did not pay. Okay. Okay. Cash paid is greater than this year's expense. When a payable decreases, subtract the decrease. When a payable decrease, subtract the decrease. That's for expense, not for income. Wait, payable decrease. When a payable decreases, subtract the decrease. 70,000 minus 17,000. It is also true for income. When a payable decrease, You owe 10,000. Now you owe 5,000. You subtract. When payable decreases, subtract the decrease. Okay, $17,000 decrease, subtract. Prepaid interest goes down by $23,000. This is the one that confuses most people. A prepaid interest decreases when you use it up. Example, last year you paid $23,000 of interest. This year you consume it. You recognize expense this year even though no cash is paid this year. So expense happened, cash did not happen. Therefore, expense is greater than cash. When a prepaid decreases, add the decrease. $23,000. So you add $23,000. The shortcut for expense questions. When converting cash paid accrual expense to accrual expense, payable increase, you add. Payable decrease, you subtract. Prepaid increase, you subtract. Prepaid decrease, you add. We gotta clip this little part right here. Okay? Payable increase, you add. Payable decrease, you subtract. Prepaid increase, you subtract. Prepaid decrease, you add. Okay. So for this question, accrued interest payable decrease, subtract. Prepaid interest decrease, you add. 70,000 minus 17,000 plus 23,000. That's 76,000. A good way to think about it, payable decrease, cash paid for old expense, you subtract. Prepaid decrease, current expense without current cash, you add. That's why the answer is 76,000. I need to come back and watch this many times because it seems like it's not clicking yet. Okay, steps to convert cash payments to accrual basis expense. Okay, step 1, set up journal entry. Credit cash for the amount paid. Determine net increase or decrease in the asset, prepaid, and liability, payable. Okay. Debit increase in prepaid or a decrease in payable, debit. Credit a decrease in prepaid or increase in payable. Amount to balance equals the accrual basis expense. Okay, I think we've got enough to think to make it happen. We have enough information. When converting cash payments to accrual basis expense, the cash paid is adjusted for net changes in the related payables and prepaid accounts. A net decrease in payable, that means debit, is deducted from the cash payments, and a net decrease in a prepaid, that means credit, is added to the payments to arrive at the interest expense. we have enough. So I need to memorize this little part. Memorize payable, memorize prepaid. That's it. And you will understand it. Zydeco reported credit sales revenue of $4,600,000, $4,600,000, $4.6 million in its income statement for the year ended December 31st, year 2. Additional information is as follows. Accounts receivable, December 31st, year 1, $1 million. December 31st, year 2, $1.3 million. Allowance for credit losses is $60,000. December 31st, year 1. December 31st, year 2, $110,000. Zeta wrote off uncollectible accounts totaling $20,000 during year 2. Under the cash basis of accounting, Zeta would have reported year 2 sales of how much? That's a lot to think about. Zydeco reported credit sales revenue of $4,600,000 in its income statement for the year ended December 31st, year 2. Additional information is as follows. Accounts receivable, December 31st, year 1, $1 million. December 31st, year 2, $1.3 million. So for year 2, there is an increase in accounts receivable. Allowance for credit losses, $60,000. December 31st, year 1. December 31st, year 2, there is an increase. It's $110,000. Okay? Zeta wrote off uncollectible accounts totaling $20,000 during year 2. Under the cash basis of accounting, Zeta would have reported year 2 sales as year 2 sales. Under cash basis. Reported credit sales revenue of $4,600,000 in its income statement for the year ended December 31st, year 2. There we have additional information. In year 2, there is an increase of $300,000 in accounts receivable. Allowance for credit loss. Let me do that because I'm getting lost. Okay. This is another accrual to cash conversion question, but now we're dealing with sales revenue, not expenses. Let's interpret it phrase by phrase. What they give you, credit sales revenue is $4 million for $4.6 million. This is accrual basis sales. Okay. Under accrual accounting, I made the sale, so I record revenue, even if the customer has not paid yet. What do they want? Under the cash basis of accounting, Zeta would have reported year 2 sales of. Now they want how much cash was actually collected from customers. So accrue revenue to cash revenue. Ignore the allowance account. Notice they give allowance for credit loss $60,000 increased to $110,000. Write-offs 20,000. Most students immediately start working with these numbers. Do not. The question asks cash basis sales. Cash basis only cares about revenue recognized, cash collected. The allowance account affects bad debt expense, not cash collections. So ignore it. Step 2, focus on accounts receivable. Accounts receivable. Year 1, 1 million. Year 2, 1.3 million. Accounts receivable increased by $300,000. What does that mean? It means Zeta recorded $300,000 more sales than it collected. Customers owe an extra $300,000 at year end. Step 3, convert accrual revenue to cash revenue. Think cash collected equals sales revenue minus increase, because some sales have not been collected yet. So 4,600,000 minus 300,000 equals 4,300,000. So that's the answer. 4,300,000. Okay? Do we understand that? Let's go back to the question. Zetco reported credit sales revenue of $4,600,000 and its income statement for the year ended December 31st, year 2. Additional information is as follows. Accounts receivable, December 31st, year 1, accounts receivable was $1 million. And December 31st, year 2, accounts receivable increased $1 million from $1 million to $1.3 million. Allowance for credit losses, $60,000, increased to $110,000. This is something we need to ignore. All right, but let's keep going. Zeta wrote off uncollectible accounts totaling $20,000 during year 2. Under the cash basis of accounting, Zeta would have reported year 2 sales of under the cash. So the information we have is under accrual. The total revenue was $4,600,000. The change we need to consider is accounts receivable. This is what affects income. This is what affects sales. Income from sales. So accounts receivable, money that you had to accounts receivable year 1 was $1 million. In year 2, $1.3 million. So there is an increase of $300,000 in accounts receivable. Okay. So how much cash have you collected? Trying to make this make sense. All right. Here is what's going on in my mind right now. The sales revenue was $4.6 million, $4,600,000. Year 1, accounts receivable was $1 million. Year 2, accounts receivable is $1.3 million. What I'm thinking about is, what about the $1 million accounts receivable? Should we deduct that $1 million from the sales revenue? From the sales revenue of 4,600,000, should not we deduct or subtract the $1 million accounts receivable? This is money that hasn't been collected yet. That's an excellent question, and it shows you're starting to think about the flow instead of just memorizing rules. The key is this. The $1 million accounts receivable at the beginning of year 2 is not part of year 2 sales. Think of it this way. End of year 1, you already had sales revenue recorded in year 1. Accounts receivable $1 million. That $1 million represents last year's sales that customer still owed, and that customer still owed you. During year 2, two things happened. Customers paid some of that old $1 million. You made new credit sales of $4,600,000. At the end of year 2, accounts receivable is $1,300,000. So instead of owing you $1 million, customers now owe you $1,300,000. That means new sales minus collections equals $300,000. The receivable balance increased by $300,000. Yes. Why don't we subtract the entire $1 million? Because some of all of that $1 million may have been collected during year 2. The beginning balance is old business. We're trying to find how much of the 4.6 million year 2 sales was collected during year 2. The beginning accounts receivable has already been accounted for in prior years. A simple example. Suppose beginning accounts receivable is $1,000 during the year. New sales $4,600. New sales. Cash collected $4,300. Then 1,000 plus 4,600 minus 4,300 equals $1,300. Ending accounts receivable is $1,300. Notice what happened. The company collected all sorts of receivables, including some of the old 1,000. The only thing we know for sure is that receivables increased by $300. That's why we only adjust for the change. $4,600 minus $300 is $4,300. Okay. When converting accrual revenue to cash revenue, don't look at the accounts receivable balances themselves. Look only at ending account receivable minus beginning accounts receivable. Because the change tells you how much revenue was recognized but not collected, or vice versa. Okay. Makes sense. So the answer is 4,300,000. 4,300,000. So 4,600,000, which is the beginning revenue, minus the change in accounts receivable, which is 300,000. 4,300,000. Okay. And that's incorrect, my friend. This is incorrect. That answer is incorrect. The answer is $4,280,000. Then they are asking for cash collections from customers, not simply adjusting sales by the change in gross account receivable. Let's build the account receivable roll forward. Gross accounts receivable, beginning accounts receivable 1 million, add credit sales 4,600,000 less write-off minus 20,000, ending accounts receivable 1,300,000. Let cash collections equals X. So 1 million plus 4,600,000 minus X minus 20,000. So 5,580,000 minus X equals 1,300,000. X equals 4,280,000. Why the $20,000 matters? Normally, when accounts receivable increases by 300,000, we would say 4,600,000 minus 300,000. That's 4,300,000. But that assumes the only thing affecting accounts receivable is sales and collections. Here, there is another event. $20,000 of receivables were written off. Those receivables disappeared from accounts receivable without being collected. Therefore, cash collections were $20,000, less than the simple 4.3 million calculation. So 4.3 million minus 20,000 is 4,280,000. Okay. We will need to come back to this question. Transactions affecting accounts receivable. Accounts receivable, beginning balance 1 million. Write off 20,000. Have $20,000 write off. Credit sales 4,600,000. Ending balance 1,300,000. Okay. Wait. Beginning balance 1 million. That's accounts receivable. Yes, accounts receivable. Ending balance is 1.3 million of accounts receivable. Okay. So the credit sales is 4,600,000. What's affecting accounts receivable? The write-off also affect accounts receivable. So that's why the answer is 4,280,000. Okay, so cash basis accounting recognizes revenues when cash is received rather than when it is earned. At times, it is necessary to convert cash basis to accrual basis and vice versa. To convert the accrual basis accounts receivable to cash basis, that means what would be reported as cash sales, set up the T account and solve for the cash collected. Accounts receivable are increased for credit sales and reinstatements of accounts written off. Accounts receivable are decreased by cash collections from customers and the write-off of accounts deemed to be uncollectible. A non-cash transaction. Since the ending accounts receivable balance was $1,300,000, the missing amount of $4,280,000 represents cash collected, which is sales under the cash basis of accounting. Beginning accounts receivable year 2 is $1 million. Accounts receivable year 2, that's beginning. Credit sales for year 2, $4,600,000. Less accounts written off, $20,000. Less collections in year 2. Plug $4,280,000. Ending accounts receivable year 2 is $1,300,000. So if you say it's $4,300,000, is because you ignore the accounts written off in the calculation. So beginning accounts receivable year 2 is $1 million. Credit sales for year 2, $4,600,000. Less accounts written off, $20,000. Less collection in year 2, $4,280,000. Ending accounts receivable year 2 is $1,300,000. Okay. So if I say that beginning account receivable is $1 million, let me see. I'm going to do that myself to see if that makes sense, because it seems like we need to have a balance at the end. Yes, beginning accounts receivable, ending account receivable, it needs to balance. So we have 1 million. Credit sales for year 2, $4,600,000. Let me see, plus $4,600,000 minus $20,000. This is the write-off. Minus $4,280,000. This is money collected. $4,280,000. Exactly. So ending accounts receivable for year 2 is 1,300,000. So when you put everything together, it needs to make sense. Okay. So, okay. All right, so what I'm looking at in this type of question, when you have beginning accounts receivable, beginning accounts receivable is $1 million. Ending accounts receivable is $1.3 million. So now I need to ask myself, what are the transactions that happen in between that will balance these transactions, these two transactions? Like accounts receivable, 1 million. I need to have enough information or enough transaction in between so that at the end, accounts receivable can be 1,300,000. So beginning account receivable of year 2 is $1 million plus credit sales for year 2, 4,600,000. So that's 5,600,000 minus 20,000 or less 20,000. That's the written off amount. Less 4,280,000. I need to find that number so that at the end we can have accounts receivable 1,300,000. Okay, that's making more sense right now because you can see the flow. What happened to accounts receivable during the year? You're building a T account in your head. Okay, beginning accounts receivable, $1 million. This is money customers already owed at the start of the year 2 of year 2. What makes accounts receivable go up? Only one thing here: credit sales. $4,600,000. Now accounts receivable would be $5,600,000. If nobody paid and nothing was written off. Alright, so if nobody paid and nothing was written off, accounts receivable would remain $5,600,000. What makes accounts receivable go down? There are two things. Write-offs, $20,000. A customer is not going to pay, so you got to write that off. Accounts receivable disappears. No cash received. Cash collections, this is the missing number. Let's call it X minus X. Ending accounts receivable, the question tells us 1.3 million. Therefore, 1 million plus 4,600,000 minus 20,000 minus X. So you solve for X. X equals 4,280,000. Okay. Minus X. The deeper understanding, what you're saying is exactly right. I have a beginning balance. I have an ending balance. What happened in between to reconcile the two? That's the FAR way of thinking. In fact, many FAR questions can be solved with beginning balance plus increases minus decrease. For accounts receivable, beginning account receivable plus credit sales minus write-offs. Okay. Write this formula in smaller letters so I can see the whole thing. Beginning balance, okay. Beginning balance plus increase minus decrease what? I can't see the whole thing. Beginning for accounts receivable, beginning accounts receivable plus credit sales minus write off or written off. I can't see the whole thing. For accounts payable, beginning accounts payable plus purchases plus payment. I can't see the whole thing. I want you to put it even in a vertical way so that the whole thing can appear on the screen. Okay, accounts receivable, beginning account receivable plus credit sales minus write-off minus cash collections equals ending accounts receivable. Okay. Or beginning accounts receivable plus sales minus write-offs minus collections, that money you collected, equals ending accounts receivable. Accounts payable is beginning accounts payable plus purchases minus cash payments. Okay, beginning accounts payable plus purchases minus cash payments equals ending accounts payable. Or beginning accounts payable plus purchases minus payments equals ending accounts payable. Inventory, beginning inventory plus purchases minus cost of goods sold equals ending inventory. Or beginning inventory plus purchases minus cost of goods sold equals ending inventory. All right. Accrued interest payable. Accrued interest payable, beginning interest payable plus interest expense minus interest paid equals ending interest payable. Okay. General FAR formula for almost every balance sheet account. Beginning balance plus increases minus decreases equals ending balance. Okay, so remember these. I'm gonna have to clip these. Okay, for almost every balance sheet account, beginning balance plus increases minus decreases equals ending balance. That's the master formula. When you see FAR questions, ask, what account am I solving for? What increases it? What decreases it? Then build the question. Beginning plus increases minus decreases equals ending. That's exactly what you did with the AR question, accounts receivable question. 1 million plus 4,600,000 minus 20,000 minus collections equals 1,300,000. So for collections equals 4,280,000. Okay. So in a question like this, you may have to solve for any of one of these numbers. You can have ending accounts receivable. You may have collection. You have the write-off, but you don't have the 4,600,000, which is the sales, the credit sales. right? Which is the credit sales revenue. If you don't have it, and you have beginning accounts receivable, which is 1 million, you need to be able to solve for the credit sales revenue. You may have everything else, but you don't have the write-off. You will need to be able to solve for the write-off. You may have everything, but you don't have ending accounts receivable, but you will need to be able to solve for it. This question takes a long time. Instead, memorize the relationship. Beginning accounts receivable plus credit sales minus write-off minus collection equals ending. Once you know the relationship, you can solve for any missing number. Example 1, solve for collections. Right? You have beginning, you have credit sales, you have write-off, you have ending. So collections equals 4,280,000. Example 2, solve for credit sales. Suppose beginning accounts receivable is 1 million, collections is 4,280,000, write-off is 20,000, ending accounts receivable is 1,300,000. Now solve for sales. So you will say 1 million plus sales minus write-off, which is the 20,000, minus collection, which is the 4,280,000, equals 1,300,000. Yeah. Show me the work of how you solve for credit sales. Absolutely. Let's solve for credit sales step by step. We start with the formula. Beginning accounts receivable plus credit sales minus write-offs minus collections equals ending accounts receivable. Plug in the numbers. 1 million plus credit sales, which is the one we don't have, minus 20,000 minus 4,280,000 equals 1,300,000. Step 1, combine the known numbers on the left. Okay. 1 million minus 20,000 minus 4,280,000 equals minus 3,300,000. What do you mean? And in accounts receivable. So now credit sales minus 3,300,000 equals 1 million. Okay, got it. So credit sales equals minus 3,300,000 equals 1,300,000. Step 2, add 3,300,000 to both sides. 1,300,000 plus 3,300,000. Solve credit sales 4,600,000. Okay, I see. So we just need to be able to solve for this. I need to spend some more time on that. This question is something that's gonna be in the exam. You need to be sure you master it. Gotta master this. Okay. All right. Company's cash basis net income for the year ended December 31st was $75,000. The following information is from the company's accounting records. Sorry. Okay, the following information is from the company's accounting records. Accounts receivable $15,000. January 1st, December 31st, $20,000. Accounts receivable increased by $5,000. Prepaid expense $7,000. January 1st and December is $4,000, so it decreased. Accrued liabilities $2,500. December 31st, well, January 1st, 2,500, December 31st, 2,000. What is the accrual basis net income? Okay. A company's cash net income for the year ended December 31st was $75,000. That's almost the same like the other question. So we start with $75,000 cash for the year ended December 31st. Okay. $75,000. The following information. All right. So we have accounts receivable. Accounts receivable increased $5,000. When accounts receivable increase, what do? You subtract. So you're going to subtract $5,000 from there. So it's going to be $70,000. Prepaid expense decreased. When prepaid expense decrease, you add. Wait. Prepaid expense decrease by $3,000. You add it, so $73,000. Accrued liabilities decreased by $500. Okay, let me do that so that we can All right, this is a classic cash basis net income to accrual basis net income question. Let's do it using the logic you've been developing. Start. Cash basis net income is $75,000. Now ask what adjustments are needed to convert cash income into accrual income. Okay. Accounts receivable, beginning accounts receivable $15,000, ending accounts receivable $20,000 increased by $5,000. So there is an increase in accounts receivable. Accounts receivable increased, that means we earned $5,000 revenue that has not yet been collected. Cash basis missed this revenue. Therefore, add $5,000. Okay, running total 75 plus 5, 80,000. Add prepaid expense. Prepaid expenses. Beginning prepaid expense 7,000. Ending prepaid expense 4,000, 3,000. Decreased by 3,000. Prepaid expense decreased. Think we used up $3,000 of prepaid assets. That means there was an expense recognized under accrual accounting that did not require cash this year. Therefore, minus, you subtract. Running total 80,000 minus 3,000, 77,000. Accrued liabilities. Beginning accrued liabilities 2,500. So ending 2,000, there is a decrease of 500. Accrued liabilities decreased. Think we paid off $500 of owed expenses. Cash went out this year, but the expense belonged to a prior year. Cash basis deducted. Accrued basis should not. Therefore, add $500. Running total $77,500. Cash basis net income 75,000 plus increase in accounts receivable minus decrease in prepaid plus decrease in accruals. When converting cash income to accrual income, revenue accounts receivable increase, add. Accounts receivable decrease, subtract. Expense accounts, prepaid increase, add. Prepaid decrease, subtract. Let me see. Account increase, add. Account decrease, subtract. Expense account, prepaid increase, add. Prepaid decrease, subtract. Accrued liabilities, increase, subtract, decrease, add. You need to understand that. So, accounts receivable when increase, add, decrease, subtract. Expense accounts, increase, add, decrease, subtract. Liability is inverse. Increase, subtract, decrease, add. Okay. You need to remember that. $77,500. A consulting company keeps its accounting records on a cash basis. During the current year, the company collected $200,000 in fees from clients. At December 31st of the previous year, it had accounts receivable of $40,000. At December 31st of the current year, the company had accounts receivable of $60,000. So there is an increase in accounts receivable and unearned fees $5,000. On an accrual basis, what was the service revenue for the current year? Service revenue for current year on accrual. Okay. A consulting company keeps its accounting records on a cash basis. So it's cash to accrual, okay? During the current year, the company collected $200,000 in fees. That's collection. $200,000 of collection. At December 31st of previous year, it had accounts receivable of $40,000. So $40,000 beginning accounts receivable. At December 31st of the current year, the company had accounts receivable of $60,000. So ending accounts receivable is $60,000 and unearned fees of $5,000. On an accrual basis, what was the service revenue for the current year? Service revenue. So what is the total revenue? Company collected $200,000. That's money that came in. So under cash, you recognize all the $200,000. But under accrual, you need to make some adjustments. Okay? December 31st of the previous year, it had accounts receivable of $40,000. Okay, so accounts receivable was $40,000 and it increased to $60,000. There is a change in accounts receivable of $20,000 and there is an unearned fee of $5,000. Okay, I'm getting to understand that. So you start with $200,000 in cash. $200,000. There is an increase in accounts receivable of $20,000. That means so you're gonna do minus $20,000. Wait. You may not say minus $20,000 because you are changing from cash to accrual. So account receivable is money for accrual. Let me do something. $200,000 minus $20,000. Unearned fees, even if it's unearned for accrual, it's money plus 5,000. That would be one. No. Into right. Okay. All right, let me do that. Okay, gonna go to break in 1 minute, 2 minutes. Let's use the same thinking you've been developing. Cash basis revenue, accrual revenue. Start with what we know. Collected $200,000. We start with that. Now adjust for things that affect revenue but not cash. Accounts receivable, beginning accounts receivable for $40,000, ending accounts receivable $60,000. There's an increase. Account receivable increase, you add. When accounts receivable increase, you add. Okay. What does that mean? We earned $20,000 of revenue that customers have not paid yet. Cash basis missed it. So $200,000 plus $20,000, that's $220,000. Step 2, unearned fees. Ending unearned fees, $5,000. Unearned fees means we receive cash, but we have not earned the revenue yet. Yeah, that's true. We received the cash, but we have not earned the revenue. We have not provided the service, so we need to subtract. So part of the $200,000 cash collected should not be counted as current year revenue. Subtracted. Okay, so that's $215,000. Wow, this should be easy. $215,000. This should be as easy. Okay, so let's go back to the question so we understand it. A consulting company keeps its accounting records on a cash basis. During the current year, the company collected $200,000 in fees from clients. At December, this is break time, but I need to finish this. It's break time, I need to finish this. During the current year, the company collected $200,000 in fees from clients. At December 31st of previous year, it had an accounts receivable of $40,000. At December 31st of current year, the company had account receivable of $60,000 and unearned fees of $5,000. On an accrual basis, what was the service revenue for the current year? Okay, so what we need to understand, we begin with $200,000. The change in accounts receivable is $20,000 increase. When accounts receivable increase, we add. So we add the $20,000. It makes it $220,000. The $5,000 is money that we receive, but we have not provided the service for yet. Under accrual, this is not money, so we need to subtract that. So we subtract $5,000. That's why we have $215,000. Okay, makes sense. All right, we'll be back.
Still take a stand, no matter if you wanna be a CPA, MD, or RN. You got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me.
Yeah.
Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. Ooh, with the great memory. With the great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. With a great memory. Come and study with me. Come and study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal.